Hello, and welcome to another edition of Wealth Management Insights. I'm Lisa Shalett, Chief Investment Officer for Wealth Management, and today is Monday, June 16th, and I'm recording this from my office in Purchase, New York. The recovery from the April bear market has been nothing short of stunning. Examining the recent retracement suggests that technical momentum, better financial conditions, and normalized implied volatility have sustained the recent rally. Investor sentiment indicates plenty of room for equities to continue to climb the proverbial wall of worry, and market leadership factor composition shows a tilt towards economic reacceleration and upside surprises. While we do respect these technical market dynamics, we're having trouble getting comfortable with this backdrop overall, given that there's been almost no resolution on major points of uncertainty. Consider first that roughly 60 days into the 90-day tariff pause, the U.S. has no major trade deals. Recent talks with China on the rare earth exports amounted to nothing more than an agreement to agree about the already existing framework of the Geneva talks established a month ago. And regarding tax policy and the One Big Beautiful Bill Act, uncertainty also reigns, with resolution appearing unlikely until August. In addition, it seems that geopolitical risks are insufficiently discounted. Consider that the IMF and the World Bank both recently reduced their forecasts for global growth, citing not only trade disruptions, but a slowing U.S. economy. As for global stability, in addition to the Israel-Hamas war, there's now been confrontation between Israel and Iran. Meanwhile, the Russia-Ukraine war has shown no signs of letting up. Against this backdrop, U.S. equity risk premiums have declined. Third, markets are showing little concern for potential weakening in the labor market. To be sure, job numbers for May were decent, keeping the unemployment rate at 4.2%. But that said, almost 1 million people exited the labor force, a record for a single non-recession or non-crisis month. Also, continuing unemployment claims continue to grind higher, recently hitting the highest level in about 4 years. Both quit rates and hiring rates are also low, and absorption of new graduates is weakening. Lastly, we also question the market's confidence around corporate margin expansion. Slowing sales growth alone presents a headwind for operating leverage. But beyond that, two indicators that we received last week give us pause. ISM prices paid indices have surged, typically a factor inversely related to margins. Also, the spread between CPI and PPI remains negative, suggesting that companies are not passing on their cost increases. This confirms the finding of a Fed survey that suggested only about 50% of companies have been passing on more than half of any tariff impact to consumers. This suggests they're absorbing the balance of impact in margin degradation. Considering all these factors, even as we recognize that the bull case we talked about last week may be plausible, for now we're continuing to proceed with caution. As risk managers first, we're hedging with a focus on reliable dividends and cash flows. Investors should consider active stock picking versus relying only on the passive index. Position portfolios for average U.S. equity returns around 5 to 10% this year in an environment of more volatility, higher real rates, and a weaker U.S. dollar. Look to diversify with international equities, commodities, and hedge funds. Energy and energy infrastructure are a favored tactical long recommendation. Lastly, staying overweight in short to neutral duration investment grade and municipal bonds still makes a lot of sense to us. Thanks as always for listening, and for more information on portfolio strategies and financial planning, please reach out to your Morgan Stanley financial advisor.